Welcome to The Explainer. Today, we're looking at a truly bizarre contrast that is literally defining the global economy right now in May 2026. On one hand, you've got a stock market that is absolutely soaring to these historic, dizzying heights, fueled by billions in tech spending. But then, on the other hand, everyday consumers are facing incredibly harsh economic realities, from skyrocketing oil prices to a deeply fragile housing market. It's this massive tug of war between Wall Street exuberance and Main Street pain. And we're going to unpack exactly how this happened and where it might be heading. Okay, let me hook you right out of the gate with a crazy question. How does a defunct, struggling wool sneaker company manage to skyrocket its stock by 582% in a single day? Okay, let's dive into this completely bizarre timeline. So Allbirds, a company that once saw its sales totally collapsing, completely dumped its footwear business on March 26 for $39 million. Poof, they became essentially a shell company. Then, just 3 weeks later, they announced this plan to raise $50 million to buy AI chips, lease them out, and literally change their name to Newbird AI. And no surprise, the market absolutely lost its mind. And honestly, this brilliantly illustrates the sheer speculative fever we're seeing right now. I mean, just compare the two. The old Allbirds had collapsing revenue, sure, but the Newbird AI has zero AI product, zero customers, and zero data centers. Yet Wall Street rewarded this total lack of product with an instant, massive valuation boost, taking their market cap from around $22 million to $159 million overnight. It's a textbook example of an AI hype bubble where just bolting the letters A and I onto your name basically creates money out of thin air. All right, moving into section 1, the S&P 500 AI boom. Market hits record high. Zooming out from that wild sneaker pivot, let's look at the broader indices. Driven largely by quantitative trading algorithms and a massive influx of retail traders, the S&P 500 has surged roughly 13% since late March alone, sitting at a staggering 7,200. And the crazy part? The big banks think it's going even higher. Goldman Sachs has set a target of 7,600. While State Street and Deutsche Bank are eyeing the 8,000 mark. The fundamental foundation of this massive bull run is this staggering number, $670 billion. That is the expected 2026 tech capital expenditure for AI infrastructure by the largest cloud computing companies. To put that into perspective, these tech giants are pouring more than 90% of their expected annual cash flow into AI data centers and hardware. This isn't just a trend anymore, it's an absolute arms race, and it is single-handedly propping up the broader stock index. Next up, Section 2, the taco trade. Shield against chaos. So, to understand the second pillar propping up this market, we really have to look at trader psychology. In Wall Street slang, this shield is known as the taco trade. Now, to neutrally decode this acronym, it stands for Trump always chickens out. Now, this isn't a political statement, it's a purely financial strategy used by analysts and traders. It basically describes a perceived tendency of the executive branch to issue bold threats, like severe tariffs or military escalations, only to delay, reduce, or reverse them the second stock markets begin to fall. Because of this, traders confidently buy the dip during global crises, relying on this perceived executive safety net to protect their portfolios. Because of this, traders believe that stock markets will always be supported because the executive branch will always come to their aid. However, geopolitical reality is kind of pushing back right now. Introduce NACHO, a newer acronym meaning not a chance Hormuz opens. With the escalating 2026 Iran war and shipping disruptions in the Strait of Hormuz, global energy markets are in total turmoil. Traders are using NACHO to illustrate that you literally cannot taco your way out of a physical, complex military blockade. It shows the very real limits of relying on market psychology when you're faced with actual supply chain and energy disruptions. Let's pivot to Section 3, the 2026 macroeconomic fragility. Main Street struggles. Now, what's really interesting about this is a profound reminder from Mark Zandi, the chief economist at Moody's Analytics. He says the stock market is not the economy. The massive success of major tech companies and AI infrastructure is completely masking some really significant pain at the household level. The contrast between these two realities is just striking. On Wall Street, you've got absolute trader confidence, with the S&P at 7,200 and market volatility sitting comfortably low. But on Main Street, it's a completely different story. Everyday consumers are grappling with painful, tangible struggles, from oil prices sitting at $103 a barrel to unemployment creeping up to 4.3%. Breaking down Zandi's specific indicators, we can really see the danger zones. WTI crude is well over the $100 threshold. And why this matters is that $100+ oil acts as a massive regressive tax on the American consumer. It basically forces families living paycheck to paycheck to cut spending on other goods, which directly threatens 2/3 of U.S. economic growth. With unemployment nearing that 4.5% recession threshold, Moody's actually places the odds of a recession at an elevated 40%. And man, the cracks go much deeper. We're experiencing what economists call K-shaped regional recessions, meaning while tech hubs might be absolutely thriving, a third of U.S. states are seeing localized downturns. The U.S. housing market remains totally dysfunctional, mostly due to record high interest rates and low development. And internationally, China is battling a staggering $19 trillion property crisis that's forcing them to flood global markets with cheap goods, effectively exporting deflation and really pressuring U.S. manufacturing. Finally, Section 4, Collision Course, Market versus Reality. So bringing these two wildly competing narratives together really shows the precarious tightrope the global economy is walking right now. The absolutely crucial point is how these threats could ultimately pop the AI bubble. Zandy outlines a 3-step sequence. Step 1, the sustained energy tax from high oil prices finally breaks the everyday consumer's spending power. Step 2, labor markets continue to soften, pushing unemployment past 4.5% and completely ruining the Federal Reserve's hopes for a soft landing. And step 3, the psychological take-o put we discussed earlier essentially expires worthless, as traders finally realize that policy changes cannot magically fix structural economic damage or open up blockaded shipping lanes. Which leaves us with this final, genuinely provocative question that every investor, worker, and economist has to weigh right now. Will the sheer, undeniable force of AI productivity and massive capital expenditure be enough to outrun a 40% risk of a global recession? Are we looking at a brand new paradigm of technological wealth or the absolute greatest economic disconnect of our time? Thank you so much for joining me on this explainer. Keep an eye on those indicators and definitely keep questioning the headlines.